Hi there. My name is Victor Aluyi, and I'm the head of investments advisory at Sankore Global Investments. This is your weekly financial markets roundoff. A Merry Christmas to you, and I wish that you have a very joyous season indeed. We start off in the US market, where it was quite a tumultuous week for US equities, with a significant increase in volatility. As a matter of fact, we saw the VIX, which is the volatility measure, the volatility index, spike from around 15 just before last week to around 24 within the week. And again, all of this was as a result of the market viewing the Fed's rate cuts as a hawkish one, as the Fed had essentially guided to a reduction in rate cuts for 2025. It basically believes that the U.S. economy, remains strong and, has a resilient labor market, particularly against the backdrop of the fact that we're seeing inflation stay sort of sticky above that, Fed's 2% target. However, in spite of all of this, the market closed Friday higher. The Dow added 1.18%, having seen its longest losing streak in almost 50 years. The S&P was up 1.09%, while the NASDAQ rose 1.03%. November's PCE reading, which came in a tad less than market had expected, printing at 2.4%, essentially helped to douse concerns around the possibility of a resurgence, in inflation, and that kind of helped with the recovery that we saw on Friday. Now, in spite of the recovery on Friday, all the major indices closed out the week, negative. The Dow lost about 2.3%, its third straight losing week. The S&P was down about 2%, while the NASDAQ shared 1.8%. Elsewhere, President-elect Donald Trump endorsed a Republican funding measure to keep the government running for another 3 months. The bill was signed by President Biden on Saturday, essentially averting a government shutdown and, basically kicking the can down the road. Basically, in another 3 months, a conversation would need to be had as to what should be done with this fiscal situation. Donald Trump has, basically voiced, the fact that they would like to do away with the debt ceiling altogether. Nevertheless, this would have very serious implications for the U.S. economy, particularly on the fiscal side. So again, this is a development that we'll certainly, keep an eye on. As the market heads into the holiday shortened week, trading is expected to be relatively muted. Investors are actually hopeful that the so-called Santa rally could see the market end the year on a high note. Since 1969, the S&P on average has added about 1.3% in the last 5 trading days of the year and the first 2 of the new year. Also, the second half of December has typically been the second strongest, period of the year for U.S. equities. And the S&P has been up about 83% of the time in December in years where we have presidential elections. So from a historical perspective, it looks like we could see a Santa rally, particularly if you look at against the backdrop of the fact that we've seen the market, dip quite significantly in the volatile week that we had last week. Month to date, the S&P is down 1.7%, while the Dow has lost 4.6%. So clearly, maybe some room for some sort of recovery as a final stretch, into the end of the year. Over in Europe, the Bank of England held rates steady last Thursday at its final meeting for the year. Again, we saw inflation rise to its highest in about 8 months, came in at about 2.6% for November, previously higher than had been expected, as service inflation remains really elevated. The Bank of England also downgraded its forecast for Q4 growth from a 0.3% growth that it had expected in the previous forecast to now a no growth scenario in Q4 of 2024. Following the announcement, we also saw borrowing costs for the UK also rise, with the 10-year gilt up about 4 basis points to 4.596. And this has also put the UK's risk premium to Germany at its highest level since 1990. Over in China, retail sales came in weaker than expected, with a 3% growth, lower than the 4.6% that had been expected. We also saw real estate investment continue to slump. January to November, we saw a 10.4% slump. This is following a 10.3% slump that we had seen for the January to October period. Again, these data points continue to reflect the challenges that the second largest economy in the world continues to be confronted with. The real estate issues, the significant slump in consumer demand, the potential for disinflationary pressures. We've seen quite some monetary measures, thrown at this challenge over the last couple of months. Not much result has been yielded. A lot of people are looking to see what the government really actually does, particularly from a fiscal side, as that is likely to be more lasting. So again, it remains to be seen what the government does, going forward. Over in Nigeria, the treasury bills market last week was relatively quiet. Really, liquidity remained sort of tight as we had liquidity in deficit territory. We also saw inflation data last week, which showed an increase. Inflation came in at 34.6%. Again, this inflation data didn't quite significantly affect market dynamics. We saw T-bill yields improve by about average basis points across T-bill curve for last week. Also for the bond market, it was largely subdued again. Trading volumes were sort of low and cautious. Saw some pockets of demand across the 31s, 34s, and also 53s. Overall, we saw average yields decline by about 1 basis points, week on week. The outcome of the bond auction with the DMO offering a total of 120 billion. It was oversubscribed by about 158 billion, while the DMO oversold by 91 billion. Stop rates closed at 21.14 and 22% respectively. And going into the rest of this week, really, like I highlighted earlier, it's a holiday shortened one. We expect volumes to be thin across board, even from global markets to our local markets. So we don't expect anything significant to happen, except looking at the US market and the hopes for that Santa rally that was talked about earlier. So that's pretty much it. We hope that you have a very, very beautiful holiday season. Thank you very much for your time.